Yeah.
A very warm good morning to all the participants, to you, Mr. Anand, to Mr. Mahalingam, all trustees and ladies and gentlemen who are participating in this webinar today. At the outset, I would like to pay my homage to Sri Nani Palkiwala and his grand legacy as a nation builder of modern India. I would also like to convey my sincere appreciation to the Palkiwala Foundation for continuing the tradition of organizing these memorial lectures. I consider it a great honor to be delivering the 39th Palkiwala Memorial Lecture today, more so among others because Mr. Palkiwala served in the Central Board of the Reserve Bank of India as a director from 1963 to 1970. Gleaning through the history of the Reserve Bank, I gather that he participated actively in discussions of the Central Board on important issues spanning bank nationalization, external aid, and development financial institutions. He invariably brought insightful perspective to the deliberations on various issues. Sri Palkiwala was a strong votary of enhancing competition in the banking sector and nurturing native entrepreneurial capabilities to spur economic progress. These issues continue to be relevant even in the present times. The immensity of Mr. Palkiwala's lifelong contribution to Indian society is well known. He was a gifted jurist who held the constitution, economic and individual freedoms in the highest regard. His conduct and integrity during the epochal Kesavananda Bharati case and in many other cases underlined the strength of his character, profound intellect, and a heart full of empathy for citizens of this country. Sri Palkiwala was an orator par excellence, both inside and outside the courtroom. Starting in 1958, his famous post-budget speeches are still remembered for their eloquence, intelligence, and sharp wit. With growing audience every year, the venue of Palkiwala's speeches on the budget kept getting shifted to bigger places. In 1983, when it was held in the Brabant Stadium in Mumbai, Vijay Merchant, the president of the Cricket Club of India, while welcoming the gathering, had remarked, Mr. Palkiwala has brought the crowds back to the Brabant Stadium as test matches had been shifted to the newly constructed Wankhede Stadium. The topic of my lecture today is towards a stable financial system. The year bygone could be marked by one of the year bygone could be marked as one of the toughest periods of human society. The unprecedented health and economic catastrophe caused by COVID-19 pandemic has exposed and widened economic and social fault lines across countries. It is therefore essential to evolve a prudent and judicious approach towards managing the financial system, not only during the pandemic, but in its aftermath. What I have done today is that I will like to focus on financial stability aspect, that is the stability of the financial system, which is the topic assigned to me. Now, let me first talk about the changing contours of financial stability over the years. Globally, the concept of financial stability has been evolving over time. With increasing complexity of the financial system, the focus of financial stability has moved beyond commercial banks and providing them liquidity during bank runs to other segments like non-bank financial institutions, financial markets, payment systems, etc. The focus area has thus widened to several other pressure points to prevent financial instability. Not surprisingly, therefore, preservation of financial stability has steadily evolved to become a major objective among central banks, implicitly or explicitly alongside traditional and evolving goals of monetary policy. Since the global financial crisis of 2008, financial stability has featured even more prominently in the discourse of central banks. It has been well documented that central banks in many countries were narrowly focused on price stability and perhaps overlooked the buildup of financial instability during the Great Moderation period. The pre-crisis consensus was for unfettered financial growth, unfettered financial sector growth, and minimal regulation that was supposed to deliver even more growth. The 2008 crisis made it abundantly clear that financial strength of individual institutions does not add up to systemic stability. That was evident because before the crisis happened, almost every financial institution reported substantial capital adequacy. This made the policymakers realize that while microprudential regulations would help determine the strength of a financial entity, they have to be complemented with adequate macroprudential regulations and anti-systemic risk measures. Preserving financial systemic stability thus emerged as the cornerstone of central bank policies. In the Indian context, maintaining financial stability remains one of the uppermost objectives of the Reserve Bank. Drawing from its wide mandate as a regulator of banks, NBFCs, and payment systems, regulator of the money, forex, government securities, and credit markets, and also as the lender of the last resort. This unique combination of responsibility, monetary policy combined with macroprudential regulation and microprudential supervision. So it is regulations are macroprudential, supervision is microprudential. So this unique combination of responsibilities which the Reserve Bank has, that is consisting of monetary policy combined with macroprudential regulation and microprudential supervision, has allowed the Reserve Bank to exploit the synergies across various dimensions. The conceptual underpinnings of financial stability as it evolved post-global financial crisis 2008 entailed preserving and nurturing a well-functioning financial architecture, which includes not just banks, but also other financial institutions, along with efficient and secure payment and settlement systems. Recent experience across countries during the pandemic suggests that even though banks, non-banks, financial markets, and payment systems remain at the core of financial stability issues, there is still a need to look much closer at the system in its entirety. In this sense, the overall objective of financial stability policies should be closely intertwined with the health of the real economy. More precisely, given that financial system works as a pivot between various sectors of the economy, and given the strong linkages across sectors, financial stability needs to be seen in a broader perspective and must include not just stability of the financial system and monetary policy, that is price stability, but also fiscal sustainability and external sector viability. All these operate in a feedback loop, and disturbances in any of these segments do get propagated to other segments with potential of disrupting systemic stability. When we look at financial stability from such a perspective, preserving and nurturing the same becomes a public good, which should facilitate creation and nurturing of congenial underlying conditions for sustained growth and development. In difficult circumstances such as the current one, it is important that all stakeholders recognize and partake in their shared responsibility for the collective benefit of society at large. History is replete with examples of such endeavors in response to difficult situations, and that, in essence, has been the story of human progress and modern economies. I would now like to focus a little bit briefly on preserving financial stability in India during the COVID-19 period. The idea of financial stability in this broader sense, as I explained earlier, that financial stability is not just stability of certain institutions, but it is intertwined with the state of the real economy. And we need to also focus at fiscal stability, external sector stability, and the real sector. So therefore, in this broader sense, the idea of financial stability molded the Reserve Bank's approach during the pandemic, which was a unique crisis, much more challenging than the global financial crisis of 2008, impacting both the real and financial sector in great severity. With conventional, unconventional, and new tools, the Reserve Bank responded through a series of measures to alleviate stress in various segments of the economy and the financial sector, including including the stress encountered by market players and financial entities. Broadly speaking, our approach to the COVID situation included the following measures. So what I propose to do is that in my, text of my lecture will be uploaded in the RBI website after this event is over. So I will not be going through all the measures which we have taken, some of which I have captured here briefly. I will not be going through all of it because that is known, that is already in the public domain. So in the interest of saving time, I will just highlight our broad approach and the measures behind, the broad approach behind our measures. The first was we undertook measures to mitigate the immediate impact of the pandemic. Secondly, we undertook liquidity augmenting measures totaling about rupees 12.81 lakh crore, which equals to about 6.3% of GDP. Thirdly, we undertook counter-cyclical regulatory measures to ease stress on borrowers and the banking system. Fourth, measures to ensure uninterrupted flow of credit. And fifth, framework for resolution of COVID-related stress for individuals and businesses. And finally, and that is the sixth point, we maintained closer surveillance of all the supervisory entities, which are, that is all the supervised entities, that is the entities which are supervised by the Reserve Bank. Our principal objective during this entire pandemic period was to support economic activity. And looking back over the last few months, looking back over the last 9 or 10 months, it is evident that our policies have helped in easing the severity of the economic impact of the pandemic. I would like to unambiguously reiterate that the Reserve Bank remains steadfast to take any further measures as may be necessary, while at the same time remaining fully committed to maintaining financial stability. Now, in this experience, there have been several learnings, and we have, this has given us an opportunity to learn many things and also to adapt our policies as we go forward. So I would now like to focus on certain adaptations and learnings from the pandemic experience and the way forward. The recent period has given us an opportunity, as I said, to learn and adapt and decide on the way forward. In today's lecture, I would like to focus on three key areas. One, stability of the banking and non-banking financial sector. Two, external sector stability. And three, fiscal stability. Let me first focus on banking and non-banking financial sectors. Integrity and quality of governance are key to good health and robustness of banks and NBFCs. Recent events in our rapidly evolving financial landscape have led to increasing scrutiny of the role of promoters, major shareholders, and senior management vis-a-vis the role of the board. The RBI is constantly focused on strengthening the related regulations and deepening its supervision of financial entities. A good governance structure will have to be supported by effective risk management, compliance functions, and assurance mechanisms. These constitute, that is the risk management, compliance functions, and assurance mechanisms. These constitute the first line of defense in matters relating to financial sector stability. Some of the integral elements of risk management frameworks of banks would include effective early warning systems and a forward-looking stress testing framework. Banks and NBFCs need to identify risks early, monitor them closely, and manage them effectively. The risk management function in banks and NBFCs should evolve with changing times as technology becomes all pervasive and should be in sync with international best practices. In this context, instilling an appropriate risk culture in the organization is very important. This needs to be driven by the board and senior management with effective accountability at all levels. In addition to a strong risk culture, banks and non-banks should also have appropriate compliance culture. Cost of compliance to rules and regulations should be perceived as an investment, as any inadequacy in this regard will prove to be detrimental. Compliance culture should ensure adherence not only to laws, rules, and regulations, but also to integrity, ethics, and codes of conduct. And a robust assurance, because I had highlighted on risk management, compliance functions, and assurance functions. A robust assurance mechanism by way of internal audit function is another important component of sound corporate governance and risk management. It provides independent evaluation and assurance to the board that the operations of the entity are being performed in accordance with set policies and procedures. The internal audit function should assess and contribute to improvement of the organization's governance, risk management, and control processes using systemic, disciplined, and risk-based approach. In all these three areas, that is risk management, compliance functions, and assurance mechanisms, the Reserve Bank has already taken a number of measures and will continue to do so from time to time. Recent efforts in this direction were geared towards enhancing the role and stature of compliance and internal audit functions in banks by clarifying supervisory expectations and aligning the guidelines with best practices. Some more measures on improving governance in banks and NBFCs are in the pipeline and will be announced in the coming weeks and months. In the last 2 years, the Reserve Bank has also initiated a series of measures to strengthen its supervisory framework over scheduled commercial banks, urban cooperative banks, as well as non-banking financial companies, that is NBFCs. The supervisory functions pertaining to these sectors are now integrated with the objective of harmonizing the supervisory approach. The possibility of working in silos has been eliminated. Earlier in the Reserve Bank, we had separate departments dealing with commercial bank supervision, urban cooperative bank supervision, NBFC supervision. So what we have now done is that we have integrated them and harmonized the various tools of supervision. And we are also doing thematic studies across all these entities, across all these sectors. And that gives us a much more macro understanding of the financial sector. The supervisory functions pertaining to these sectors are now integrated, as I said, and the possibility of working in silos have been eliminated. We have developed a system of early identification of vulnerabilities to facilitate timely and proactive action. We have been deploying advances in data analytics to offsite returns so as to provide sharper and more comprehensive inputs to on-site supervisory teams. So when on-site supervisory team visits a particular bank or an NBFC or an urban cooperative bank, he would have received a lot of inputs already from our off-site back office through the use of technology, data analytics, a lot of questions to be asked, a lot of areas to be looked into. So the supervisor goes much more well prepared and well armed to supervise the regulated and the supervised entity. And we have developed system of, as I said, that early identification of vulnerabilities to facilitate timely and proactive action. We have been deploying advances in data analytics, as that also I have mentioned. The thrust of Reserve Bank supervision is now more on root causes of vulnerabilities rather than dealing with symptoms. Bank-wise as well as system-wise supervisory stress testing adds a forward-looking dimension for identification of vulnerable areas. A risk-based supervision framework focusing on know your customer, that is KYC, and anti-money laundering, that is AML risk, has been created in line with global best practices. Fintech initiatives are being embraced in the form of innovative technologies for regulation, that is RegTech, and supervision, that is SupTech. As regards regulatory intervention in banks to protect the interest of depositors, our approach in recent times has been to first work closely with the management to find a workable solution. When this does not work, we have intervened and put in place new arrangements within a quick time schedule. With preservation of financial stability and depositors' interest being uppermost in our agenda, we could swiftly resolve the situation at two scheduled commercial banks. Notwithstanding improvements being made, it is recognized that enhancing and refining supervisory framework is a continuous process. The RBI remains strongly committed to preserve the stability of the financial sector. We will do whatever is necessary on this front. Going ahead, financial institutions in India have to also walk a tightrope in nurturing the economic recovery within the overarching objective of preserving long-term stability of the financial system. It's a tightrope walk. It's a tightrope walk because the recovery is now visible. The economic recovery is visible. The banks have to play a very banks have to be in the forefront of this. The banks have to play a very supportive role. At the same time, the banks will have to also balance the requirements of financial stability. The current COVID-19 pandemic related shock will place greater pressure on the balance sheets of banks in terms of non-performing assets, leading to erosion of capital. Building buffers and raising capital by banks, both in the public and private sector, will be crucial not only to ensure credit flow, but also to build resilience in the financial system. So timely capitalization of banks, both public sector banks and private sector banks, I have been stressing this repeatedly. It's very important to support the revival process and also to ensure that the banks have stable and robust balance sheets. We have indeed advised all banks, large non-deposit taking NBFCs and all deposit taking NBFCs to assess the impact of COVID-19 on their balance sheet, asset quality, liquidity, profitability, and capital adequacy, and work out possible mitigation measures, including capital planning, capital raising, and contingency liquidity planning, among others. Preliminary estimates suggest that potential recapitalization requirements for meeting regulatory norms, as well as for supporting growth capital, may be to the extent of 150 basis points of common equity tier 1 capital ratio of the banking system. And this is something which was stated in the Reserve Bank's report on trends and progress of banking in India, which was released recently. Prudently, a few large public sector banks and major private sector banks have already raised capital, and some have plans to raise further resources, taking advantage of the benign financial conditions. This process needs to be put on fast track. Let me now turn to the external sector stability. Given that domestic financial sector closely interacts with external sector through various channels, it becomes a critical segment from a financial stability perspective. A weak external sector can pose a threat to domestic financial stability. In the face of swift changes in global economic environment, as was the case during the global financial crisis 2008 or during the taper tantrum of 2013. External sector conditions are generally captured through movements in current account balances, capital flows, exchange rates, foreign exchange reserves, and external debt position. Sudden changes in any of these indicators due to global shocks and or domestic developments can impact the viability of external sector and its interaction with the domestic economy. Notwithstanding the worsening of both external and domestic demand conditions impinging on exports and imports since the onset of COVID-19, external sector has remained resilient. Lower trade deficit driven by steeper fall in imports coupled with resilient net exports of services translated into large current account surplus to the tune of 3.1% of GDP in the first half of the current financial year. With surplus in the current account, the scope of absorption of strong flows of foreign direct investment and portfolio investments by the economy was limited, which led to a large accretion in foreign exchange reserves. Sustained accretion to foreign exchange reserves has improved reserve adequacy in terms of conventional metrics, that is cover for imports, which is now 18.4 months, and reserves to short-term debt in terms of residual maturity, which is now 236%. Sound external sector indicators augur well for limiting the impact of spillovers and possible global shocks and financial stability concerns, as investors and markets are credibly assured of the buffer against potential contagion. While abundant capital flows have been largely driven by accommodative global liquidity conditions and India's optimistic medium-term growth outlook, domestic financial markets must remain prepared for sudden stops and reversals should the global risk aversion factors take hold. Under uncertain global economic environment, emerging market economies typically remain at the receiving end. In order to mitigate global spillovers, EMEs, that is emerging market economies, have no recourse but to build their own forex reserve buffers, even though at the cost of being included in the currency manipulators list or monitoring list of the US Treasury. I feel that this aspect needs greater understanding on both sides so that EMEs can actively use policy tools to overcome the capital flow related challenges. At the Reserve Bank, we are closely monitoring both global headwinds and tailwinds while assessing domestic macroeconomic situation and its resilience. I now turn to the last part of my speech, which focuses on financial stability. The COVID-19 pandemic has further brought to the fore the need for governments to spend on merit goods and public goods, in particular on improving human and social capital and on physical infrastructure. As per IMF's calculations, the total fiscal support in response to COVID-19 amounted to about 12% of global GDP by mid-September 2020. Global public debt is said to reach 100% of global GDP in the year 2020. As a result, most economies are expected to emerge from the pandemic with higher deficits and debt vulnerabilities. Under these circumstances, and given the expenditure requirements to support the process of economic revival, fiscal stability becomes an even more important constituent of overall financial stability. Although the scale of fiscal spending is expected to breach quantitative targets of fiscal prudence across most economies in the short run, it was crucial in the context of the pandemic from the point of view of welfare aspect, from the perspective of welfare aspect of public expenditure. Expenditure on physical and social infrastructure, including human capital, science and technology, is not only welfare enhancing, it also paves the way for higher growth through their higher multiplier effect and enhancement of both capital and labor productivity. Under these circumstances and going forward, it becomes imperative that fiscal roadmaps are defined not only in terms of quantitative parameters like fiscal balance to GDP ratio or debt to GDP ratio, but also in terms of measurable parameters relating to quality of expenditure, both for center and states. While the conventional parameters of fiscal discipline will ensure medium and long-term sustainability of public finances, measurable parameters of quality of expenditure would ensure that welfareism carries significant productive outcomes and multiplier effects. Maintaining and improving the quality of expenditure would help address the objectives of fiscal sustainability while supporting growth. In conclusion, I would like to say that looking ahead, our financial system faces both challenging times and new opportunities as the Indian economy returns to full vitality. New vistas of financial intermediation leveraging on technology and new business models will emerge. With the exponential growth of digitization and online commerce in India, the Reserve Bank has also directed its policy efforts to put in place a state-of-the-art national payments infrastructure while ensuring a safe, secure, efficient, cost-effective, and robust payment ecosystem. The Reserve Bank is positioning itself to provide an enabling environment in which regulated entities are catalyzed to exploit these new avenues while maintaining and preserving financial stability. The regulated entities, on their part, need to strengthen their internal defenses to identify emerging risks early and manage them effectively. Financial stability, as I said earlier, and I would like to repeat, financial stability is a public good, and its resilience and robustness needs to be preserved and nurtured by all stakeholders. At this juncture, we need to support economic revival and growth. We need to preserve financial stability. Thank you very much.
Thank you, sir. That was not only a very comprehensive analysis of the present state of affairs as far as the pandemic is concerned and the learnings that brought to bear on this particular review, but I think you also painted the picture as to how going forward we need to tackle the issue of financial stability. There are two takeaways, and then I will quickly move to the Q&A session. I think that these takeaways are extremely important, not only from a regulator perspective, but also from a regulatory perspective. Cost of compliance is an investment, not an expenditure. Operating in silos will not be the best way to approach any supervisory aspect. I think these are two very important aspects from a governance standpoint, which you very rightly pointed out. There are several questions which are coming in the chat box and even earlier. The first two questions I would questions. Mr. Mahalingam, please.
Yeah, thank you very much for this really extraordinary lecture covering the wide spectrum. As Ranan said, there have been a few questions that have really come in. One of the issues that has been engaging the attention of a lot of people is really the development of money market or bond markets. Why is it still underdeveloped, and is there any mechanism that you have in place to nurture the development?
Yeah, on the bond market, on the bond market, you would have seen in the last 1 or 2 years, we have taken several measures. And it's a continuous process, and we are regularly in dialogue with the various market participants. There has been a lot of discussion between the RBI and the SEBI. And let me say that so far as the government securities, government bond market is concerned, the government securities are concerned, I think India has one of the most liquid markets in terms of entry norms and also in terms of the ease of exit. So that is, with regard to the government securities market. But private bond markets, yes, many more steps need to be taken. We are in discussion with the SEBI. During the pandemic period, you would have seen that when in the month of February and more in March, the bond markets in India had almost frozen. And RBI, then we injected a lot of liquidity through these targeted long-term repo operations, through long-term repo operations, that is LTRO and TLTRO, and the bond market was revived. So we found initially that all our, liquidity measures were more to the, particularly the higher rated companies, the AAA rated companies in particular, they were able to raise resources. But the system also needed the bond market down the line to get activated. So therefore, we then undertook targeted liquidity, TLTRO, as I said. We undertook financing of, let us say, the MSME segment, the cooperative banking segment through the All India financial institutions like the SIDBI, the NABARD, and the National Housing Bank. So that is, I have focused more on the operational aspect. And on the regulatory side, we are working on it. So it's a work in progress, and some more steps would be required. We are working on them.
Right. Thank you. And, there have been a lot of questions on the debt recovery mechanism what can be done to speed up, including the mechanisms of addressing acceleration of the, of recovery. At the same time, you've also talked about, I'm slightly diverging, but you've also talked about recapitalization requirements of banks, and that, in terms of undertaking the development activities and so on, that is in store as we exit from the current crisis. There is one question on the concept of bad banks. and whether there are any institutional reform that you can really bring in. So I'm trying to put together a number of observations that have come in. Would you like to comment on some of these?
You see, the bad bank has been under discussion for a very long time, and I think it's we have in RBI provided we have regulatory guidelines for asset reconstruction companies, and we are open to look at any proposal for setting up a bad bank. We are open to it, and from a regulatory we are open in the sense that what I am saying is that if any proposal comes, we are open to examining it and giving it the required regulatory issuing the regulatory guidelines. But then it's for the government and it's for other private entities, private sector players to really plan for it. So far as RBI is concerned, we try to keep our regulatory framework in sync with the requirement of times. If there is a proposal, please mark my words, if there is a proposal for setting up a bad bank, RBI will examine and take a view on that.
Anand, would you like to continue?
Yes, sir. There are several questions around the NBFC sector, but I'll try to bunch them together. I think the scale-based regulation, which has been now talked about in the NBFC, larger companies to be regulated more, smaller companies to be regulated less. I think it's a step in the right direction. And the question which the small NBFCs are asking is, they should be regulated and provide. They must have access to more capital and loans from banks. Is the RBI seriously looking at some sort of a solution for these small NBFCs?
You see, our scale-based regulation for NBFCs, as we announced in our last MPC on 4th of December, the discussion paper is almost ready. It will come out in the next few days, perhaps next week. And the scale-based regulatory guidelines, we have, the focus is to nurture the sector, to ensure that the NBFC sector, that is the big entities as well as the small entities, they have sufficient flexibility to operate and grow. At the same time, the focus also will be on, prescribing certain prudential regulations. So therefore, so far as the smaller NBFCs is concerned, I think I will, I said it, I alluded it to in my lecture today. Now, our experience shows whether a large NBFC or a small NBFC, a large bank or a small bank, ultimately what differentiates, the differentiating factor among them is the quality of governance. Now, you have small NBFCs which have good quality of governance, who are able to access the money market, who are able to get funded by the banks. In fact, the bank credit to the NBFC sector has remained fairly steady even during this COVID-19 period. Of course, the banks have been helped by our, the long-term repo operations, but at the same time, it has remained steady during this entire period. So therefore, small, big, I think the emphasis should be more on the quality of governance, and secondly, and equally important, on the business model. I think that also is very important, whether there is appropriate risk culture within the NBFC, whether it is big or small, there has to be appropriate risk culture also within the entities. So if that is done, I'm sure whether it's a small NBFC or mid-sized NBFC, and I'm saying it out of our experience, that once you have a governance model which is robust, once you have a business model which is robust, I think even the small and medium NBFCs are able to access money, both from banks and money markets.
Thank you, sir. I think the emphasis on business model is so vital for NBFCs. The next question is around more regulations in the financial sector, sir. If you look at the financial sector, banks, non-banks, mutual funds, insurance, they are regulated by agencies. The question is there now so the way in which the financial sector is evolving and developing, to have a nodal regulator which will sort of align all these regulations to make them work faster? That's the question.
No, I didn't quite get the question. Are you talking of a super regulator who will look also after the, whatever RBI is doing and whatever SEBI and IRDA is doing? Is that the question? I didn't quite get it.
The question is, the question is whether we, yeah, I think it's
your voice is breaking. Your voice
regulations.
is
breaking. Okay. Is it clear now, sir?
No,
it's breaking in between, so I'm missing out quite a bit.
Hello, is it clear now? Okay,
yeah,
okay.
Go ahead, slightly better.
I think it is about multiplicity of regulations. Yeah. The question is regarding multiplicity of regulations and whether we need to have an alignment or bring in a common regulator. That's the question.
I think common regulator was, one of the recommendations of the Justice Shri Krishna committee. And I think a view has been perhaps taken that, we are today, I mean, instead of going into a common regulator, let me focus on what you said, that the regulations are becoming complex. You see, we have to also keep in mind the fact that the financial sector has become very complex. And the financial sector has also become highly interconnected. So to deal with this issue of interconnectedness and complexity of the financial sector, and to ensure that all the regulators, that is whether it is the RBI or the SEBI or the IRDA or the Pension Fund Regulatory Authority, to ensure that all these regulators work together. As you know, we have the mechanism of the Financial Stability and Development Council, chaired by the Finance Minister. Under that, we have, under the aegis of the FSDC, we have a subcommittee of the FSDC. And the subcommittee again consists of all these regulators. The subcommittee meetings are chaired by the RBI governor and the chairman SEBI, chairman IRDA, and all other regulators. They participate in that. And this subcommittee of FSDC meets more frequently and discusses various inter-regulatory issues and inter-regulatory issues, and also aspects of risk build-up in the financial system, which requires concerted action by the various regulators. So therefore, I think the focus should be on maintaining good communication between the various regulators, which we are doing. We have regular communication between the various regulators. And you see, if you have a single regulator, I mean, I'm not going into it. It's a much larger topic. I'm not going into it. But again, a single regulator also has its own, has its own downsides, in the sense that it will become so huge and the economy is so, the financial sector has become so large and so complex that a common regulator may lose sight of various segments of the regulatory requirements. So whereas if you have a SEBI looking at the capital markets, and they are much more focused. If you have a RBI looking at the financial stability, money markets, financial markets, the monetary policy, then it's much more focused. You have IRDA, which is much more focused on the insurance sector. And interregulatory issues, in any case, we do meet and interact and try to sort of resolve if there are any common issues.
Yeah. There is,
I think we have time for one final question. Mr. Mahalingam, you want to take it? Yeah.
You talked about this revival of the economy and, various areas, including people working together. The question is really on the elbow room that many of the states have in terms of even looking at the quality of expenditure. There is a fairly big debt that has been accumulated during this process at this point in time. And therefore, there is going to be some mechanism by which they should be in a position to deal with that as they look at many of their expenditure patterns. Is there any view that you have on this?
No, what I was saying is that all welfare expenditure, I mean, the first thing is that the when you're looking at public expenditure, that is public finance of at the state and at the central level, I think the quality of expenditure is important in the sense that what kind of multiplier effects or what kind of productive outcomes it is going to produce. Whether it is a one-time benefit or it is a benefit which is recurring in nature. So, of course, in certain situations, one-time benefits will have to be given. For example, if there is a natural calamity, if there's a flood, if there's a cyclone, you need to give one-time support to the affected people. So, I'm not generalizing saying that one-time benefits or one-time support should not be given. But while deciding on your in a normal situation, while deciding on the composition of your expenditure, I think it is necessary to focus on those aspects of expenditure. For example, capital expenditure is, by and large, capital expenditure has multiplier effects. Certain amounts, certain kinds of revenue expenditure also have multiplier effects, and all revenue expenditure is not bad. I was only focusing on the expenditure which every rupee that the government spends, whether the state or the central government, every rupee the government spends, what is the outcome? What is the multiplier effect that it is generating? What percentage of my, of our expenditure is going towards one-time benefits or one-time, some one-time measure? And what percentage is going into one-time measures are important, as I said, in certain situations. I would like to clarify lest I'm misunderstood. And what percentage is going into areas which have multiplier effects. I think I have posed an issue. I have posed an issue that along with the measurable, quantifiable targets of fiscal sustainability, that is, debt to GDP ratio or the fiscal deficit limits, etc. These are quantitative parameters. Along with that, can we develop an index or a matrix to measure a set of metrics to measure the quality of expenditure? I have posed this more by way of a question, and we are working on it in the Reserve Bank. Internally, we are working on it, I should not say, but we are internally, there is a lot of brainstorming, a lot of discussion going on. So it is more, the intention was to place it in the public domain and generate more discussion.
Yeah. Mr. Malingam, can you make the concluding remarks on the vote of thanks? For that, may I request all the audience to give a virtual round of applause to the governor for having taken time out and spent time with us. Thank you very much, sir. Mr.